All right, welcome to our video on the income statement, specifically talking about gross margin. As we talk about different formats for the income statement, it's important for you to be able to be flexible. In other words, not all income statements are organized exactly the same. So in this video, we're going to talk about a specific section called cost of goods sold, which then gives us a value called gross margin, and a little bit why that's important in the income statement format. Take a look. All right, welcome to our video on the income statement. Specifically, we want to talk about this area called cost of goods sold. You know, in our example today, I've got a beef company that sells cut beef products. And so they have a revenue of ground beef, steak cuts. That's a gross sales of, let's say, $300,000. Now, there is a section of the income statement called cost of goods sold, and its sole purpose is to kind of answer what are the direct costs for all the products we sell. So, for example, if we sell ground beef and steak cuts, then very likely we have an expense, and that expense would be probably called meat purchases. Now, you could actually call that several things as far as the descriptions, but you get the idea. If we are selling final cuts of ground beef packages and steak cuts, then we probably are having to purchase that meat in a raw form, and that would be meat purchases. Let's say it's $120,000. Now, direct cost also might be transportation. So not only we're buying the meat, but we have to transport it to get it to where we need it to be so that we can refine it. Let's say that's $8,000. So in our example, that's $128,000 of expenses that relate to our sales. And that's the function of cost of goods sold. Now, when you get a cost of goods sold, you end up with something called gross margin. And gross margin is just the difference between gross sales and cost of goods sold. So it's the amount of money left over. And so if we're looking at our example here of 300,000 minus 128, well, that's not the right number, not 378. That would be dumb. So the difference between our gross sales of 300,000 minus the 128,000 of cost of goods sold would be somewhere in the neighborhood of, let's say, $182,000. That would get us to our 300,000 in sales. So gross margin is, again, gross revenue minus cost of goods sold. And so how is this used? Well, it's a great way, once you have the number, to look at a percent of sales that our gross margin represents. So that's the money we're keeping out of what we sell. So what's that percentage? Sometimes it's looked at as a return per dollar of sales. And so you can do some simple divisions of 182 divided by 300. That's how much we get to keep. Or for every $300,000, we get to keep 182 of it. In either case, this is a useful set of information for you to better manage your business. And so if you have a business where you're selling product, cost of goods sold is a common category. Now, after that, you're going to have operating expenses, which are going to be things like labor, depreciation, interest expense. All the other costs with running our business continue just like we would have in a normal income statement. You get to the bottom line after this, called net income, and so that is the bottom line of every profit and loss or income statement or statement of income. Either one, those are all identified words to describe an income statement, but our focus is this cost of goods sold section. That's the important part in managing a business. And again, cost of goods sold is a cost that is not fixed, it's variable. So as ground beef sales go up, we're probably having to buy more meat. So this is called a variable cost. As we buy more product, we're having to pay more in transportation. So you end up with a ratio. Every time revenue goes up, variable cost or cost of goods sold go up. And so you're really always looking at that ratio percentage.